Imagine watching every single sector of the stock market just bleed red, like wiping out billions in value across the board.
Yeah, it's a tough thing to watch.
Right. But then there's this one lone survivor. Because in the first quarter of 2026, the market didn't just dip, it basically panicked.
Oh, totally. It panics.
And we are looking at a financial briefing today, specifically the Absher 2026 first quarter briefing. And it describes a landscape behaving completely irrationally.
Very rational. I mean, it's messy, it's emotional.
Yeah, and frankly, it's terrifying if you're just looking at the headlines.
Welcome to the deep dive, by the way. Our mission today is to decode this highly volatile update and help you separate that, headline noise from the actual signals for long-term wealth building.
Which is so important right now, because the author of these notes keeps using this one specific phrase to describe the market. They call it ugly weather.
Ugly weather. I like that.
Right. They acknowledge that March 2026 felt like a full-blown crisis. I mean, they compare the feeling to the most panicked days of the tariff scares a few years ago, or even COVID, right?
Exactly, those chaotic first months of COVID.
Yeah.
But they treat this simply as a passing storm.
Okay, but let's unpack this. Because how do you physically survive a drop where major benchmarks fall, like 5 to 15% in a single month? That doesn't feel like just a passing shower to me.
No,
Yeah.
It really doesn't. But to survive it, you have to look at the anatomy of that drop. These notes highlight something pretty incredible.
What's that?
Of the 24 or so industry groups tracked by the major indices, only one actually made money in March. Just one.
Wow. And that was oil and gas, right?
Yep. Energy. Everything else took on water. And that specific energy spike was fueled by Brent crude oil having its best price gain since the 1970s.
Which perfectly sets the stage for what we are digging into today. We're going to look at why this massive sell-off is happening, and more importantly, how the strategy in this briefing aggressively uses this exact panic to go bargain hunting.
Which is the best part.
Yeah, and the best place to start is with that one singular survivor, which is energy. Because the way this briefing handles their biggest energy winner completely breaks conventional wisdom.
It's entirely counterintuitive.
Yeah.
I mean, what's fascinating here is the portfolio we're looking at has tracked Chevron for 30 years.
30 years. And they hold Shell and Exxon too, right?
Right. And Chevron has been an absolute powerhouse for them. Clearly their best performer during this March bloodbath. But despite it being their biggest winner, the author actually trimmed their Chevron holdings.
By almost 50%.
Yeah, from nearly 200,000 shares down to around 100,000.
Wait, so your best player is scoring all the points, carrying the entire team, and you bench them?
That's what it looks like on the surface.
Because if I'm managing a portfolio, my gut instinct is to let my star run. But they mentioned doing this because of something called book value.
Right, book value.
Let's break that down for the listener.
Right.
When they say book value here, are they basically just talking about the scrap value of the company? Like if you tore it down to the studs?
That is the perfect way to look at it. Book value is what a company is theoretically worth if you sold off all its physical assets and paid off all its debts today.
Okay, so for an oil giant like Chevron, those physical assets are just billions upon billions of barrels of oil reserves sitting underground.
Exactly. And because of the current conflicts and supply shocks happening globally right now, oil is temporarily trading around, $120 a barrel.
But Chevron can't possibly pump and sell all of its billions of barrels today at $120. It's a physical impossibility.
They physically can't.
Right. It's going to take them decades to get all those reserves out of the ground and to the market.
And that is the exact trap the broader market falls into. You can't value the entire company as if all their future oil will forever sell at today's panic-induced high price. That's a dangerous mistake.
Because right now, Chevron is trading at around 1.4 or 1.5 times its book value, right?
Yeah, which is the highest premium it has seen in 20 years. It is incredibly expensive relative to the actual physical stuff it owns.
It reminds me of flipping houses. You don't fall in love with the bricks of a house.
Oh, that's a good analogy.
Right. You trade based on the neighborhood's temporary market value, or it's like holding a massive inventory of umbrellas during a hurricane.
Yeah, everyone's desperate.
Exactly.
Yeah.
You can sell your umbrellas at a huge premium while it's pouring, but you also know the rain is eventually going to stop.
You don't hoard them thinking the hurricane lasts forever.
Exactly. You sell them at the peak of the panic, fully aware you can buy them back for pennies when the sun comes out.
And that discipline is the core of this strategy. You buy energy shares when oil prices are rock bottom, knowing it's temporary, and you sell them when prices spike, knowing that's also temporary.
There's an old market adage they quote in the notes, right? The best remedy for high oil prices is high oil prices.
Right, because the mechanism of that price spike eventually destroys itself.
Because when oil hits 120, two things happen simultaneously. First, every other supplier on Earth scrambles to get their oil to market to cash in.
Which floods the system with new supply.
Exactly. And second, normal people simply can't afford to fill up their cars, so they drive less. Or factories scale back production.
Which destroys demand.
So you have supply rocketing up while demand falls through the floor and the price inevitably crashes back to reality. So they took their profits, cut the Chevron position in half, and secured that cash.
Right. So moving from that one energy lifeboat, we have to look at what was actually pulling the rest of the market underwater.
Oh, man.
Because we're pivoting from the old school pipeline and barrel economy to the bleeding edge tech economy. The Magnificent Seven, right?
Yeah, they're having a truly terrible quarter. It's an absolute bloodbath in tech. The briefing details Oracle's stock losing more than half its value since late last year.
Half its value. That's stunning.
And it got so bad that Oracle's bonds started trading like junk bonds, meaning the market suddenly views their corporate debt as incredibly risky, bordering on default.
Yeah, and it's not just Oracle. Microsoft, Amazon, Meta, Google, even the darling of the market, NVIDIA, they've all seen very meaningful drops.
And the core fear driving this massive tech sell-off comes down to one word: CapEx.
Capital expenditure.
Yes.
The underlying mechanism here is basically an infrastructure arms race. These massive tech companies, the hyperscalers as they're called.
Right, because they scale up the internet for the rest of us.
Exactly. They are burning through billions of dollars to build out artificial intelligence data centers. They're spending money at a staggering rate, and the market is terrified that this spending just isn't sustainable.
Well, yeah, because everyone naturally assumes AI is just a software game. You know, you type a prompt into a chat box on your phone, and it feels like magic floating in a digital cloud.
But there is no cloud.
No, AI is actually a brutal real estate and electricity game. These data centers are massive, physical warehouses packed with servers that run incredibly hot.
And they require millions of gallons of water to cool.
Yes, and consume mind-boggling amounts of gigawatts.
Which brings us to a fascinating second-tier effect of the AI boom, which is the electric utilities.
Oh, this part is crazy.
Right. You would naturally assume that if AI needs all this power, electric utility companies must be the ultimate guaranteed winners of the AI revolution.
Yeah, they've been an incredibly popular trade for a lot of investors this year.
But this briefing explicitly avoids them. The author absolutely refuses to touch utility stocks right now.
Yeah, and put yourself in this position. Imagine trying to pay a massive variable rate mortgage on a brand new power plant that you just had to build to keep those AI servers humming.
It's a huge burden.
Building power plants requires borrowing billions of dollars. And you're doing this right as interest rates are skyrocketing. I mean, 20 and 30-year treasury bonds are pushing a 5% yield right now.
The notes actually share a brilliant historical callback to illustrate this exact trap.
Oh, the Duke Power story.
Yeah. 45 years ago, the author remembers buying Duke Power when the stock had fallen by half, just so the company could offer a 10.5% dividend to its investors.
Wow, 10.5%.
Right. Because back in that high inflation environment, safe, risk-free government bond yields were so high that utility companies had to offer astronomical dividends just to convince people to buy their stock instead of a guaranteed government bond.
And fast forward to today, and that same trap is snapping shut. Think about companies like Duke Energy or Nexter Energy today. You have utility companies carrying heavy debt service to build this AI grid. At the exact same time, their investors are demanding higher dividends because they can just go get a 6 or 7% yield on a completely safe 10-year treasury bond.
The math fundamentally breaks down. High debt loads, plus the requirement to pay high dividends, all operating in a high interest rate environment. That is a structural recipe for stock prices to collapse.
It's a structural trap.
Yeah, and the author sees that trap clearly and is staying far away from the utilities.
So we have the panic laid out for you. AI, CapEx fears, utility debt tracks, dropping tech giants. But it's fascinating how this strategy relies on capitalizing on other people's panic. They view this irrational, emotional market as a massive buying opportunity. Because when investors are indiscriminately selling everything without looking at the underlying business, great companies go on sale.
They refer to this as a classic Mr. Market environment.
Oh, I love the Mr. Market concept.
It's so helpful. Imagine having a business partner who is wildly manic depressive. Some days he's euphoric and wants to buy your half of the business for a fortune.
And other days he's terrified and offers to sell you his half for pennies.
Exactly. The market is acting like that terrified partner right now.
And the briefing shows they went on a serious shopping spree because of it. Since the end of the year, they increased their position in Abbott Labs by 70%. They
Wow.
increased Strawman by 60%, Visa by 40%, Microsoft by 30%, L'Oreal by 10%. But the purchase that really highlights the strategy for me was Emerson Electric.
Oh, yeah. Emerson is a great example.
Because Emerson is down 25% recently, yet they increased their position by 33%. What is the specific mechanism making Emerson so attractive while everyone else is bailing?
Well, Emerson is a preeminent player in global energy infrastructure and domestic factory automation. When you see news about oil fields or natural gas terminals being damaged in the Persian Gulf, the market panics.
Right.
But the author realizes that someone actually has to rebuild that infrastructure.
Yeah.
If there's a sudden increased demand for North American natural gas to supply Europe because of global conflict, that creates direct, tangible demand for Emerson's hardware and engineering.
So the real-world geopolitical chaos actually guarantees a pipeline of massive new contracts for them over the next 3 to 6 years.
Yes, yet their stock price dropped 25%, purely because the broader market was throwing a tantrum about the next 30 days.
It's wild. Now, to balance this out, the strategy also involves trimming positions that got swept up in positive but unjustified hype.
Trimming the hype is just as important as buying the feed.
Absolutely. And a perfect example in the notes is Starbucks. They cut their Starbucks holdings by 25% because the stock shot up to around $100, purely on the excitement of them hiring the former CEO of Chipotle.
Oh, right. People were buying the narrative of a miracle worker CEO.
Exactly. Rather than looking at the actual underlying mechanism of how many cups of coffee were being sold in a tough economy, the stock got too expensive based on a story, so they took their profits before gravity took over.
Makes sense.
And they did the same thing with Google, trimming it by 20% and Snap-on Tools by 15%.
But I think the most compelling additions to the portfolio are the companies the author believes possess what they call invisible moats against the AI disruption we talked about earlier.
Yes, the invisible moats.
They added 25% more to ADP, making it one of their largest holdings. And they built a massive new position in Intuit, the makers of QuickBooks and TurboTax.
Right.
They built that entirely during this market sell-off.
Let me play devil's advocate on this one for a second. If you're listening to this and seeing the massive leaps AI is making, you're probably thinking a smart algorithm could easily replace a payroll company like ADP or a tax software like TurboTax.
It's a fair question.
I mean, AI can already write code and pass the bar exam. Why pay a massive corporate fee when a bot can just do the math? Why double down on those specific companies?
It's a highly illogical assumption, but it completely ignores the regulatory reality of the physical world. Processing payroll isn't just about doing the math correctly.
Right.
ADP processes payroll across 50 different states and 60 different countries.
And every single one of those jurisdictions has different tax codes, different labor laws, varying compliance hurdles, and immense penalties if you get it wrong by a single decimal point.
Exactly. The moat protecting ADP isn't their software. The moat is their immense legal and regulatory compliance infrastructure. A brilliant AI startup from Silicon Valley might have faster code, but they do not possess the global legal framework to guarantee compliance.
And to assume the liability for a multinational corporation's payroll.
Right. ADP does. That's a massive invisible shield.
That's fascinating. And it's the exact same story with the London Stock Exchange Group, LSEG. The briefing shows they increased their share count there by 10%.
Yeah, LSEG is interesting.
Because the broader market is terrified that AI will disrupt traditional financial data providers because bots can just scrape information, right?
Supposedly.
But the notes highlight a crucial mechanism. 95% of LSEG's high-quality, verified financial data is locked tightly behind a paywall.
And that matters, because if an AI model like Gemini or Claude hallucinates a recipe for a cake, it's a funny mistake.
Right, you just get a bad cake.
But if it hallucinates a stock price or a corporate earnings report, someone loses millions of dollars. These AI developers desperately need verified, pristine data to train their models. They can't just guess.
So if they want the world's best financial data, they are forced to pay LSEG for access. AI isn't a threat to the London Stock Exchange. AI is simply their newest, wealthiest customer.
Exactly. Whoever owns the proprietary data holds the toll booth.
So we've covered the energy lifeboat, the tech panic, and the bargain hunting for these invisible moats. But that panic isn't just limited to tech stocks and AI data centers.
No, it's broader than that.
Yeah, there's a much bigger macroeconomic weather pattern brewing that this strategy is bracing for. The briefing outlines a thesis that we are entering what they call a lower octane version of the 1970s.
Which is quite a phrase. This implies structurally higher inflation, persistently higher interest rates, and a forced shift back to domestic manufacturing.
Right, because if global supply chains remain fractured and unpredictable, the U.S. has no choice but to start building things at home again.
And that structural shift is why the notes favor companies like Fastenal and Lincoln Electric. These are businesses that directly supply the nuts, bolts, and welding equipment needed for domestic factory buildouts.
Yeah. But the 1970s comparison in this briefing isn't just economic, it's heavily geopolitical.
It really is. The author details a growing global disdain for American trade policies, the rumblings of a broader global trade war, and deep uncertainty in the Middle East that mirrors historical pressure points.
And we want to be very precise here for you listening. The briefing specifically points to the Middle East, noting that U.S. involvement in helping Israel has created what the author views as a parallel to the historic oil embargoes of the 1970s and a global energy crisis.
Yeah.
And to be completely clear, we are strictly looking at this through the lens of the author's clinical risk assessment of global supply shocks. They are mapping out potential energy crises based on historical cause and effect, completely separate from taking any political stance.
Right. It is a cold calculus of supply chains. When geopolitical tensions escalate in regions that produce the world's energy, severe energy crises historically follow.
Makes sense.
And there is a ticking clock attached to this, which the notes call the midterm election egg timer.
Oh, right.
The current administration has a massive political incentive to stabilize these global crises before the end of the year. They cannot afford to spend an election cycle fighting an energy-driven recession.
But even if the geopolitical weather stabilizes, there is one more macroeconomic fear lurking in the shadows of this briefing. It's something Jamie Dimon referred to as the cockroach warning.
Ah, yes. Private credit.
Private credit.
The market is waking up to the terror of hidden debt within private credit funds. Over the last few years, when interest rates were near zero, massive amounts of money poured into these unregulated private funds.
In a desperate search for yield, right?
Exactly. And a lot of those funds made mediocre, high-risk loans to shaky businesses.
And the mechanism of the cockroach warning is simple. You see one bad loan default, but you know there are thousands more hiding in the walls.
Yes.
Now that interest rates are pushing 5%, those shaky businesses can't afford their debt payments, and those loans are starting to default.
And this impacts the broader strategy. The author mentions they actually cut their position in M&T Bank by 10% during a recent rally, even though they fundamentally like the bank.
Right, because M&T deals primarily in small business loans and owner-occupied real estate with a very conservative 65 to 70% loan-to-value ratio.
Right.
Meaning they only loan out 65 cents for every dollar a property is actually worth. That gives them a massive safety cushion.
So M&T is mostly immune to the private credit mess. But the author still trimmed the position because of the reality of financial contagion.
Yeah, I like to think of it like a margin call at a high-stakes casino. Imagine a reckless gambler who loses absolutely everything at the poker table. That's the private credit funds making terrible loans. Suddenly, the casino boss comes to collect. The gambler doesn't have the cash, and he certainly can't sell his bad poker hands. So he has to run out to the pawn shop and sell his prized, authentic Rolex watch just to cover his debt.
That's exactly it. Now multiply that by 1,000. You suddenly have a bunch of desperate people flooding the market, forced to liquidate their best assets, their cheap Rolexes, to survive. And it drives down the price of Rolexes for everyone else, even if your Rolex is perfectly fine. In the stock market, when these private funds need cash to cover their defaults, they are forced to sell their high-quality blue-chip stocks.
And that desperate selling drags down the share prices of great companies temporarily. Your high-quality portfolio drops not because your companies are failing, but because someone else in the market is desperately liquidating.
Exactly.
So bringing this all home, what does this mean for your strategy as an investor? The ultimate takeaway from this volatile briefing is that right now, because of all this compounding fear, the AI capex panic, the utility debt trap, the 1970s stagflation anxiety, the private credit cockroaches.
It's a lot of fear.
It is. But because of that, truly high-quality businesses are trading at incredibly cheap valuations. We are talking about great companies trading at 10 to 15 times earnings, or 10 to 15 times free cash flow,
Right.
which is just the actual hard cash left over in the register after paying the bills to keep the lights on.
And valuations that low usually do not last long unless the underlying business is fundamentally broken. And in the case of Visa or Microsoft or ADP, the mechanics of their businesses are incredibly strong.
You cannot control the ugly weather. You can't stop the interest rates from rising, and you can't prevent global supply shocks. But you can decide whether you are going to panic with the crowd or if you are going to use the storm to meticulously build a portfolio of high-quality assets at a massive discount.
That's the real lesson here.
Real quick, a logistics note for the clients following this strategy. The quarterly company reports detailing earnings and dividends will be arriving in your email in the next 7 to 10 days.
And the physical hard copy performance reports will be arriving in the mail mid-month, so keep an eye out for those.
Perfect.
Before we wrap up, I want to leave you with a final thought to ponder, something that builds on everything we've decoded today.
Good, let's hear it.
If we truly are entering this lower-octane 1970s era, an era where the physical world, domestic manufacturing, energy pipelines, heavy machinery, global supply chains, if all of that suddenly becomes vastly more valuable and critical than the digital software-only world we've obsessed over for a decade,
Yeah.
how does that massive structural shift change the way you view your own career? How does it alter the trajectory of your specific industry or the businesses you rely on every single day?
Oh, wow.
Are you strategically positioned for a world that suddenly has to remember how to build hard physical things in real life again?
It's a powerful question to ask yourself right now. You might want to make sure your own house is built with good bricks rather than just nice software.
Thank you so much for joining us on this deep dive. The weather might be ugly out there, but as we've seen today, that just means incredible things are going on sale. We'll see you next time.